So let's take a look here as we expand this right over here. We have got a condition right now for interest rates, which are inverse to treasuries that I deem to be quite positive. Now, the most negative case that I can make is that they'll only get up into this area right over here, which are the resistance zones. So this starts at about 4.2% on the 10-year up to here, which is about 4.37%. It could get much higher. This trough right over here really looks like the low that was made. I thought that there might be a little different timing on the low, but there was not. And you can see that what we had was interest rates pop, interest rates come down, interest rates pop, interest rates come down. And look at the cycle rhythms in here. They are crazy good, as you could see. So this one came right here at the beginning of that window of timing right there. Actually, that's misplaced. It should be a little bit earlier in here, and this one should be moved over because we had a slight left shift. So the ideal low on interest rates would have been around the second to third week of November, and the low actually came here around the third or fourth week of October. And if I, just zoom further out in here, you can see how these cycles work. Now, the further back you go, because I can't readjust these cycles further back, you can see that they get off rhythm in here. But these are perfect. This right in here was a little bit shorter. And if you just look at the vertical timing lines in here, you can see that they are really very regular when you look at that. And this low right over here looks very much like the interest rate low. So while the Fed is talking about cutting interest rates, we have massive borrowing by the government. We have massive amount of supply that is very, very likely to come out in the Treasury market that will need to get sold at higher interest rates. And we have China stimulating, Japan coming out with stimulus now of 125 billion. This morning they reported that. These worlds have to keep stimulating their fiat currencies to keep everything alive, because they're now completely living in a debt economy. And what the bond market will do is price in the necessity for higher rates to get these things sold. And the potential for higher inflation based on all of that stimulus. And you look at this, there's hardly a way you can make a case for interest rates going down. Fed might cut interest rates again one time, but I tell you what, I think interest rates are going up. Let's take a look here at this pattern in here. This is just exquisite. So you see the cycle rhythms in there. They're not exactly perfect, but the principle of variance says that they won't be. And then right over here, where it's getting down into this support, you can see this positively configured cycle being built in here. This area right over here, which is between 4.08% and about 4.03%, which are right now just above that. It dipped into it, is the buy zone in interest rates. But you can't buy the interest rates. You need to sell the treasuries. That's why we have it listed that way. So you can see in here, there may be some few more days in here where treasuries can get a little bit more pop because there is some little safety bid coming in, but not much. But then after that, I think interest rates are going up, and this would be the beginning of it right there. And then interest rates, that cycle, looking something like that over there. That means that in this next week, treasuries have a high probability, it's not perfect, high probability of offering shorting opportunities, as this likelihood is that interest rates will be going up.